Right now, over 60% of all global foreign exchange reserves are held in US dollars, and those dollars are invested primarily through Wall Street financial institutions, and we're talking about over $7 trillion that foreign governments park in US Treasury bonds and American financial assets because they have no better alternative. And here's what makes this completely insane. Because Wall Street banks and investment firms manage more assets than the GDP of most countries, and a single firm like BlackRock manages over $10 trillion, which is more than the annual economic output of every country, except the United States and China. And the largest Wall Street banks process over $5 trillion in transactions daily and set the interest rates that affect mortgages and business loans and government borrowing in nearly every country. And when you look at global capital flows, the pattern is overwhelming because money flows toward New York, regardless of where it originates. And a pension fund in Norway, or a sovereign wealth fund in Singapore, or a billionaire in Russia, all route their investments through Wall Street institutions, because that's where the deepest markets and the most sophisticated services and the highest liquidity exist. And the question that economists and foreign governments obsess over is how a few square miles in Lower Manhattan gained such total control over global finance that virtually every country on Earth is dependent on Wall Street institutions for managing their wealth. And the answer involves 7 specific mechanisms that work together like a machine where each component reinforces the others. And when you understand these 7 reasons, you'll see that Wall Street's dominance isn't about being better at finance, it's about controlling the infrastructure and the systems and the networks through which global money must flow. And the first reason is something that was established 80 years ago and still dominates today. And that's the Bretton Woods system and its aftermath, which made the US dollar the world's reserve currency and forced global finance to center on American institutions. And this single decision created permanent advantages that compound daily. And here's how Bretton Woods created Wall Street dominance, because in 1944, when 44 countries met in New Hampshire to redesign the global financial system, they agreed to peg their currencies to the dollar, and the dollar was pegged to gold. And this made the dollar the foundation of international finance. And even after the gold peg ended in 1971, the dollar remained dominant because the infrastructure was already built and switching costs were enormous. And think about what this means structurally, because if every country needs to hold dollar reserves and conduct international trade in dollars, then they need relationships with institutions that can handle dollar transactions at scale, and the institutions that can do this are Wall Street banks because they're based in the currency's home country and have direct access to the Federal Reserve and can clear dollar transactions efficiently. And compare this to trying to manage global dollar transactions through a bank in Frankfurt or Tokyo, because you're always going through intermediaries and paying conversion costs and dealing with time zone differences. And Wall Street banks have the advantage of operating in the same jurisdiction as the currency issuer. And here's the compounding effect, because once global finance centered on New York, the infrastructure developed there, and the expertise concentrated there, and the talent moved there. And this created network effects where being in New York became essential for global finance. And foreign banks had to open New York offices, and foreign investors had to work with Wall Street firms, and the system became self-reinforcing. And beyond the dollar's role as reserve currency, there's also the depth of dollar-denominated debt, because over $13 trillion in debt is owed by non-US borrowers in dollars, and servicing this debt requires dollar transactions. And Wall Street banks facilitate these transactions and earn fees. And this creates permanent revenue streams and permanent relationships. And the second reason is what actually makes Wall Street institutions so powerful. And that's their control of the global payment system, which means that international money transfers must flow through networks that Wall Street banks control. And this infrastructure control creates choke points that allow extraction of fees and enforcement of rules. And here's how the payment system works. Because when money moves between countries, it doesn't physically travel. It moves through accounting entries in correspondent banking networks. And the dominant system is SWIFT, which handles messages between banks. And the actual dollar clearing happens through New York banks that maintain accounts at the Federal Reserve. And this means that a payment from a Brazilian company to a Chinese supplier, even if neither has anything to do with America, must clear through New York because it's conducted in dollars. And think about the control this creates. because Wall Street banks can see these transactions and can delay them, or block them, or charge fees for processing them. And this visibility into global money flows provides intelligence about economic activity worldwide and allows front-running and informed trading. And compare this to other financial centers which handle regional transactions but can't match New York's centrality in global dollar flows, because London handles euros and Asian centers handle yen and yuan, but the dollar dominates international commerce, and dollar clearing happens in New York. And here's the leverage this creates, because the US government can use the payment system to enforce sanctions, and when America wants to punish a country or a company, it can cut them off from dollar clearing. And this exclusion is devastating because it prevents international trade and foreign investment. And during the Iran sanctions, American pressure forced SWIFT to disconnect Iranian banks, and this crippled Iran's ability to conduct international commerce. And the same mechanism was used against Russian banks after the Ukraine invasion. And beyond government sanctions, there's also the commercial aspect, because Wall Street banks charge fees on international transfers. And these fees seem small individually but generate billions annually, because the volume is enormous. And estimates suggest that cross-border payments generate over $200 billion in annual fees, and Wall Street banks capture a large portion of this. And the third reason is something that operates invisibly but determines where global capital flows, and that's Wall Street's control of the international bond markets, where governments and corporations raise money. And this control means that countries wanting to borrow must work with Wall Street institutions and accept their terms and pay their fees. And here's how bond markets create control, because when a country wants to borrow internationally, it issues bonds, and those bonds need to be sold to investors. And the institutions that connect borrowers and investors are Wall Street investment banks. And these banks underwrite the bonds and distribute them to investors and provide credit ratings and secondary market liquidity. And think about what this means for a country like Argentina or Indonesia or even major economies like Japan. Because when they want to raise money internationally, they hire Goldman Sachs or JP Morgan or Citigroup to manage the bond issuance, and these Wall Street banks advise on pricing and structure the deal and market it to investors and charge fees that can reach tens of millions on a single transaction. And compare this to trying to raise money without Wall Street involvement, because investors demand the credibility and the distribution network that Wall Street provides, and a bond issued without major bank support will either fail to sell or will require much higher interest rates to compensate for lower liquidity. And here's the mechanism that creates dependency, because once a country has dollar-denominated bonds outstanding, it needs to maintain relationships with Wall Street banks to ensure market access for future borrowing and refinancing. And this creates ongoing leverage where Wall Street banks can influence policy through their role as gatekeepers to capital markets. And beyond sovereign debt, there's also corporate debt, because companies around the world issue dollar bonds to access lower interest rates than available domestically, and Wall Street banks dominate this market. And Chinese companies have issued hundreds of billions in dollar bonds, underwritten by Wall Street firms, and European corporations routinely tap US bond markets. And this creates relationships and dependencies that extend beyond American borders. And here's the scale of the market, because over $20 trillion in bonds trade globally, and dollar-denominated bonds represent about 40% of this. And Wall Street banks are the primary dealers and market makers, and this gives them information advantages and pricing power. And the fourth reason is what makes Wall Street's advantage sustainable over decades, and that's the concentration of financial expertise and talent that creates capabilities no other financial center can match, and this human capital advantage compounds through network effects and institutional knowledge. And here's why talent concentration matters so much, because modern finance is incredibly complex and requires expertise in derivatives and structured products and risk management and algorithmic trading and regulatory compliance. And the people who understand these areas at the highest levels are disproportionately concentrated in New York, because that's where the most sophisticated transactions happen and the highest salaries are paid. And think about what this creates, because Wall Street firms can assemble teams that combine expertise across multiple domains and can solve problems that firms elsewhere can't. And a complex cross-border merger or a structured financing deal or an exotic derivative might require knowledge of tax law and accounting standards and regulatory frameworks. And market dynamics across multiple jurisdictions, and Wall Street firms have professionals who specialize in each of these areas. And compare this to financial centers in other countries, which might have competent professionals, but lack the depth and the specialization that comes from handling the most complex transactions repeatedly. And a bank in São Paulo might do a few international deals per year, while a Wall Street bank does hundreds. And this experience gap creates capability gaps. And here's the talent magnet effect, because ambitious finance professionals from around the world move to New York, because that's where they can work on the biggest deals and earn the highest compensation and learn the most sophisticated techniques. And this brain drain means that even countries with strong educational systems lose their best financial talent to Wall Street, and graduates from top business schools in Europe and Asia often end up in New York because the opportunities are better and beyond. Individual expertise. There's also institutional knowledge, because Wall Street firms have been operating for decades or over a century and have accumulated knowledge about markets and clients and strategies, and this knowledge is embedded in their systems and processes and culture and can't be easily replicated. And the fifth reason is something that seems purely technological but creates enormous barriers to competition, and that's the trading infrastructure and data systems that Wall Street has built, which handle transactions at speeds and scales that other financial centers can't match. And this technological advantage creates first-mover advantages in markets. And here's how infrastructure creates control. Because modern financial markets are increasingly electronic and speed matters enormously, because milliseconds can mean the difference between profit and loss in algorithmic trading. And Wall Street firms have invested billions in technology to reduce latency and increase processing capacity, and the fastest trading systems can execute transactions in microseconds. And think about what this enables, because firms with faster technology can see market movements before slower competitors, and can act on that information before others react. And this advantage seems small, but generates enormous profits through high-frequency trading and arbitrage. And the technology arms race means that staying competitive requires continuous investment. And compare this to financial centers in other countries, which generally have less sophisticated trading infrastructure, because the volume doesn't justify the investment. And Asian exchanges have grown, but still lag Wall Street in technology. And European markets are fragmented across multiple countries, and this fragmentation creates inefficiencies. And here's the data advantage, because Wall Street firms have decades of historical market data and sophisticated analytics. And this data allows modeling of risk and prediction of price movements and identification of opportunities. And firms like Renaissance Technologies and Two Sigma have built businesses entirely around exploiting data advantages. And beyond trading technology, there's also the settlement and clearing infrastructure, because transactions need to be settled, meaning ownership needs to transfer and payment needs to be made. And the institutions that handle clearing for U.S. securities are Depository Trust Company and others that process trillions in transactions daily. And this infrastructure is robust and reliable and difficult to replicate. And the sixth reason is what gives Wall Street influence over corporate behavior globally, and that's the control of equity markets, where companies raise capital by selling shares. And this control means that companies wanting to access global investor pools must list on Wall Street exchanges and submit to American regulations and disclosure requirements. And here's how equity markets create power. Because the New York Stock Exchange and NASDAQ are the largest stock exchanges in the world, with combined market capitalization over $50 trillion. And these exchanges attract listings from companies around the world, because that's where the deepest pools of capital exist, and the most liquidity and the highest valuations. And think about what this means for a Chinese technology company or a European pharmaceutical firm. Because if they want to raise significant capital and achieve premium valuations, they list American depository receipts on Wall Street exchanges, and this means complying with SEC regulations and U.S. accounting standards and submitting to oversight by American regulators. And compare this to companies that list only on domestic exchanges, because they typically receive lower valuations and less liquidity and less analyst coverage. And this valuation gap can be substantial, where identical companies might trade at 30 to 50% higher multiples in New York than in other markets. And here's the control mechanism. because once companies are listed on Wall Street exchanges, they become subject to American corporate governance norms and shareholder activism, and this influences how they operate even outside America. And Wall Street investment banks that underwrite initial public offerings gain intimate knowledge of these companies and ongoing relationships. And beyond the direct capital raising, there's also the index inclusion factor, because the major global equity indices are dominated by U.S. stocks, and passive investors who track these indices automatically buy American equities, and this creates persistent demand for Wall Street listed stocks and reinforces the advantage. And the seventh and final reason ties everything together, and it's the legal and regulatory framework that makes New York the preferred jurisdiction for complex financial contracts. And this legal advantage means that parties choose New York law and New York courts, even when they have no connection to America. And here's how legal infrastructure creates financial dominance, because complex financial transactions require legal certainty about how contracts will be enforced and what happens in disputes. And New York has developed over centuries a body of commercial law that's sophisticated and predictable and widely respected, and most international financial contracts are governed by either New York law or English law. And New York courts are viewed as neutral and competent arbiters. And think about what this means, because when a bank in Singapore lends money to a company in Brazil, the loan agreement will likely specify New York law as governing and New York courts as having jurisdiction. And this choice isn't random. It's because New York legal precedents are well established and predictable, and this reduces uncertainty. And compare this to choosing the legal system of one of the parties, because neither Singapore law nor Brazilian law has the same depth of financial jurisprudence, and neither jurisdiction is viewed as neutral. And using New York law provides a framework that both parties trust. And here's the institutional advantage, because New York law firms have developed enormous expertise in financial transactions and can draft contracts and structure deals in ways that minimize legal risk. And these firms work closely with Wall Street banks, and together they've created standardized documentation and practices that are used globally. And beyond the contract law, there's also the regulatory framework, because U.S. financial regulators are sophisticated and credible, and markets regulated by the SEC are viewed as more trustworthy than markets with weaker oversight. And this credibility attracts capital from investors who want protection against fraud and manipulation. And when you combine all 7 of these reasons together, you see why Wall Street controls the money of literally every country, because the dollar's role as reserve currency forces global finance through New York, and control of payment systems creates choke points that enable fee extraction and surveillance, and bond market dominance makes Wall Street the gatekeeper for international borrowing, and concentration of financial talent creates capabilities others can't match, and trading infrastructure provides speed and data advantages, and equity market control influences corporate behavior globally, and legal framework creates predictability that attracts complex transactions. And these 7 mechanisms reinforce each other in ways that make the system nearly impossible to displace, because reserve currency status drives payment flows, which generate fees that attract talent, which creates expertise that enables complex transactions, which require sophisticated legal frameworks, and the cycle continues. And the result is that Wall Street institutions process and manage and control flows of money that dwarf their actual capital, because they're operating as intermediaries in a system where all roads lead through New York. And a Wall Street bank might have $1 trillion in assets, but control or influence $10 trillion in client money and facilitate $100 trillion in annual transactions. And this leverage creates enormous power and enormous profits. And understanding these 7 reasons shows that Wall Street's control isn't about free market competition, where the best services win. It's about structural advantages and network effects and first-mover benefits that have compounded over 80 years, and attempts to create alternative financial centers have consistently failed, because the switching costs are too high and the network effects are too strong. And Shanghai wants to be a global financial center but can't, because the yuan isn't freely convertible, and Chinese capital markets aren't fully open, and legal system isn't trusted. And Frankfurt thought the euro would challenge dollar dominance, but euro-denominated finance still primarily flows through London and increasingly through New York, because that's where the infrastructure is. And here's the geopolitical implication. Because Wall Street's control of global finance gives America enormous power to reward allies and punish adversaries through access to capital markets and payment systems. And this financial power often exceeds military power, because you can't shoot your way out of being cut off from dollar clearing, and countries that oppose American interests find themselves unable to borrow internationally or conduct trade or attract investment. And this financial weapon was used against the Soviet Union and is being used against Iran and Russia and potentially against China. And the dominance is so complete that even countries that resent American power have no choice but to work through Wall Street institutions because the alternatives are too expensive or too risky or don't exist. And this is why Wall Street controls the money of literally every country in the world and will likely continue to do so, because the structural advantages are overwhelming and self-reinforcing, and the only way to break this control would be to simultaneously create an alternative reserve currency and build equivalent payment infrastructure and develop comparable bond markets and attract equivalent talent and build matching trading systems and create liquid equity markets and establish trusted legal frameworks. And no country or group of countries has succeeded in doing even one of these, let alone all seven. And this is why Wall Street's dominance over global finance appears permanent, and why understanding these mechanisms is essential for understanding how power operates in the modern world.